Welcome back. Well, now we're going to talk a little bit about ratios, how they're calculated, and how they're used. Before we begin, please download the sample operating statement attached below. Once you have that, let's review some of these ratios. Let's talk about the operating ratio, the percentage of effective gross income consumed by operating expenses is expressed as an operating ratio. However, the ratio can be misleading because it reflects, in part, both the efficiency of management and the property itself. A low operating ratio may indicate that managers have not allocated sufficient funds to maintain the property, resulting in deferred maintenance. Some investors seek properties with high operating ratios, aiming to reduce them through efficient management and thereby increase the property's value. Let's examine this case. Again, the operating ratio is calculated by dividing total operating expenses by effective gross income. In this case, you'll see the numbers pulled directly from the operating statement for year 1. That works out to be 44.29%. And just in general, that happens to be somewhere right in the middle. It's okay. Before I delve too far into this, the course Real Estate Investment for Your Future provides a much deeper discussion of these operating ratios, including how they are calculated, used, and interpreted. In this course, our discussion will be more practical, focusing on how the various ratios are calculated. How is it done? Let's discuss the break-even point. Break-even ratios are most effectively used in conjunction with pre-tax cash flow. They indicate the relationship between cash inflows and outflows from all sources. In this case, the break-even ratio is calculated by taking the operating expenses, adding the debt service, and then dividing that total by the effective gross income. As you can see, the numbers were pulled directly from the operating statement, and the break-even ratio is 66.77%. Effective gross income must fall substantially before investors see a negative return. The next ratio is the debt coverage ratio. This ratio expresses the extent to which net operating income can decline before it becomes insufficient to meet the debt service application. This indicates the safety associated with the use of borrowed funds. The debt coverage ratio is calculated by dividing the net operating income by the annual debt service. Or in this case, the debt coverage ratio is expressed as 2.48. An alternative perspective is that the net operating income constitutes 248% of the debt service, which is noteworthy. Due to this debt coverage ratio, it would be highly attractive to lenders. I suspect it would be easy for the investor to find a lender for this property. Next, the equity dividend rate. It is a measure that incorporates the effect of using borrowed money. It compares equity cash flow with the amount of equity invested. Many investors, however, consider the usefulness to be limited because the analysis does not incorporate income tax considerations. In this case, the equity dividend rate is the before-tax cash flow divided by the initial cash investment. Again, looking at that operating statement, it is a 20.97% return. That is undeniably good. Next, let's discuss the cash-on-cash ratio, a standard measure of profitability used in real estate investment analysis. Cash on cash is equivalent to the equity dividend ratio. However, it does take into consideration the impact of taxes. In this case, when the after-tax cash flow is divided by the initial cash investment, the return is 19.6%. Wow, not bad at all. For the first year, that would be considered an excellent return. Let's proceed to the following lecture.